This is the next video in the series 4.3.2 on factors influencing growth and development. Today we're going to be looking at access to credit and banking as a factor that affects economic growth and economic development. So an important term for you to be familiar with is financial intermediaries. A financial intermediary is an entity that acts as the middleman between two parties in a financial transaction. The two parties that are brought together by banks, because banks are a financial intermediary, the two parties that are brought together by banks are savers and borrowers. Households save part of their income, saving being the act of postponing consumption. So savers provide loanable funds. Those loanable funds are deposited with banks who pay the saver interest. That's used to be the case, not anymore. Anyway, and let's not be cynical. And borrowers are the second group that banks bring together. Borrowers are again, the customers of banks, but what borrowers do is that they borrow loanable funds. In the case of firms, when they borrow, it's typically to finance loans that are needed to purchase capital. So firms borrow to invest into their own businesses. So one more time, financial intermediaries are organizations that act as a middleman between two parties in a financial transaction. So banks are a financial intermediary because they bring savers and borrowers together. So digging a little bit deeper into this, how do banks make profit? Well, I know they make profit from charges, bank charges. For example, if you want to take some of your own cash out as a saver from the bank, at most auto banks now, you'll have to pay £1.50, £2 for the privilege of extracting some of your own cash from your bank account. But if we forget about that, the other way that that banks make money is through what's called interest arbitrage. So arbitrage is making a profit from price differences that exist. So what do banks do to profit from arbitrage? Well, they'll take my savings from me. I have my current account with NatWest. Money goes into that. I need a current account just to cope with day-to-day expenditure. But anyway, NatWest pay me the princely sum of 0.1% interest on any cash that I have saved in my current account. What do NatWest do with that money? Well, then they lend that out to, might be a startup, and they'll charge maybe 20% interest on a startup loan. Or it might be that they use some of my savings to finance a car loan for a 25-year-old at 12% interest. Or maybe a student that wants a credit card that gets stung 14% interest. So banks make profit by paying savers a much lower interest rate than they charge to borrowers. So just make this example kind of really clear with some numbers. Imagine that a bank on average paid savers 1% and charged borrowers 10%. That would involve the bank running a gross profit margin of 9%. That they charge 10% but only pay 1% to savers. The difference between those different interest rates charged to savers and borrowers is the bank's gross profit margin. Okay, so that's the first slide done then. So banks are financial intermediaries. They act as a middleman in a financial transaction. In this case, the transaction is between savers and borrowers. I save my money. The bank uses my money to make loans to households and firms that want to borrow it. Firms borrow money to purchase capital in the main. So let's move on. In practice, developing countries are not homogeneous. They're all different. There's no such thing as a typical developing country. However, the exam board are not as enlightened as this. They're not really don't really understand reality too well. So a dial a cliche kind of point that you can make that will get tick, 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 lots of marks is that developing countries typically have underdeveloped financial markets. So there might be a shortage of banks, pension funds, credit card companies, insurance companies. So a typical low-income developing country, they have a problem, a development problem, which is they haven't got properly developed financial markets. And as I say there, this is a bit of a dial a cliche point, but it's a good one for you to know, because you can just recite that back to the exam board and they will give you some ticks for that. So why is the absence of financial markets a problem in a typical developing country? Well, it all goes back to the first slide, which is this idea that banks act as a financial intermediary. They act as a financial go-between between households that save and companies that want to borrow. So in a country that doesn't have a proper banking system, households don't park their savings in a bank account. They keep them at home, stuffing them under the proverbial mattress. So that creates a disconnect between savers and borrowers. Savers are saving at home, cash under the mattress. They're not saving with banks. So that creates a problem for banks in that they don't have any loanable funds in their bank vaults. The loanable funds are under the mattress at home. So another dial a cliche theme that you've already come across before is that the typical developing country is primary product dependent, and there are all manner of problems associated with primary product dependency. So the kind of consensus mainstream view is that to develop, developing countries need to move away from primary products. They need to industrialize. That's the original kind of idea. Move away from primary product dependency by establishing a manufacturing sector. However, to compete in manufacturing, you need investment. Manufacturing tends to be capital intensive, so developing countries will need to undertake that initial burst of capital expenditure if they are to set up a secondary sector. Now, as the Harrod-Domar model set out for you, firms will need to borrow from banks to get the cash needed to buy expensive bottling material, or even maybe sewing machines, even something simple. There will still be some capital expenditure involved. Now, the problem is that if households are saving at home, then banks are deprived of loanable funds. And because banks are deprived of loanable funds, firms can't approach banks and borrow. And because there aren't any loanable funds in the bank, because the loanable funds are at home under the mattress. So as a consequence of a lack of credit, firms can't fund capital expenditure projects. So the levels of investment are disappointingly low, which means that without that investment, productivity growth will also be disappointingly slow. If output per worker is growing slowly, that will also condemn the economy to a rather disappointing rate of economic growth. And it may well be that I've put here a slower pace of development, but actually development could go backwards because the birth rate might actually be greater than the economic growth rate, because you're struggling on the growth front, because you're struggling on the productivity front, because you're struggling on the investment front, because you don't have banks, and there's no loanable funds because households are saving at home. So this is again a sort of a dial-a cliche point, but it's a logic chain that will score you marks big time in the exam. So the moral of the story then is that banks are super duper important. They act as financial intermediaries. You need to get that into your answer. They're like a dating agency that brings together savers with borrowers. I won't probably bother with the dating agency analogy in an exam, but hopefully you'll get the picture. Banks connect savers with borrowers, and that makes investment possible. Banks therefore indirectly create economic growth, because without banks there wouldn't be the capital expenditure, because there's no loanable funds with banks that firms can borrow, and the economy doesn't grow very well as a consequence of underdeveloped financial markets and a lack of financial intermediaries. I guess it's also important to recognise that banks allow households and firms to have easy access to cash without the risk of it being stolen. So banks enable firms to pay wages and pay suppliers in a very convenient manner. So during the financial crisis of 2008, the banks were very quick to point out that they had to be saved. They were too big to fail, because if the banks went down, there would be no economy. People wouldn't be paid their wages. People wouldn't be able to access the money that they'd earned, because the banking system would be shut down. Firms wouldn't be able to pay their suppliers, and there would be an almighty economic crash. And the banks played this card very successfully, persuading the government to bail them out at taxpayers' expense. Your expense, because you're the generation that's going to be paying taxes to pay for those bailouts. You can also argue that financial markets, access to credit and banking, it's also important for households, not just for firms. In many developing countries, there isn't a functioning welfare state. You could even look at Britain, actually, and we've got quite a lot of people living homeless on the streets of the UK. So what does that imply about the UK's welfare state? Anyway, whatever. It's certainly true to say that in a developing country, there's no welfare state, or if there is one, the benefits provided are minimal, and they might not even ensure the elimination of absolute life-threatening poverty. So you could argue that in a developing country where there is no welfare state, people have to look after themselves. So if you look at this old person in the picture, too old and too decrepit to work. So how's this person going to generate an income in retirement to live off? The answer is, of course, this person needs to have saved during their working life. They need to have bought income generating assets, and during their retirement they don't have to sell their labour to earn an income, because they've used financial products like pensions and the stock market to purchase income generating assets, and during their twilight years they can sit at home and spend the income, the unearned income that's been generated from the assets that they've bought. So you could say that accessing credit and banking is like very important for the poor in the developing world, because it enables them to buy financial assets throughout their working life, and in essence accumulate a stock of wealth that will generate regular unearned income, enough to live off. Now, in a country that doesn't have financial markets, it won't be possible for households to purchase income generating financial assets, because the financial sector is underdeveloped. So this is a massive problem. So in countries where financial markets are underdeveloped, people like this old geezer will struggle because they weren't able to purchase financial assets because there wasn't properly functioning financial markets. So this is an important point. We'll have a little bit of Keynesianism. It's no lesson is complete without a little bit of mad dog Keynesianism. So Keynesians believe that the level of aggregate demand determines the level of output and employment. So Keynesians say that anything that you can do to increase the level of aggregate demand is a good thing because firms will respond to it by producing more. That will lift GDP, and the requirement to produce more goods and services will also increase the derived demand for labour. So Keynesians say that credit and financial markets are really important because credit enables a household to consume more than their income. High levels of consumption lift aggregate demand because consumption is a component of aggregate demand, and that creates economic growth. So access to credit and a buy now, pay later culture, Keynesians would argue that this can be really positive for economic growth because access to credit lifts consumption, lifts spending, firms respond by producing more, employing more people, rinse, lather and repeat. It could also be argued that it's difficult to run a cash economy without banks. This is because banks are needed for the safe storage of cash. And without cash, trade would have to take place on a barter basis. Now, as you remember from theme 1, the main problem with barter is that it's inefficient because of the double coincidence of wants problem. And if you have a barter society, specialization is discouraged, and that's a bad thing because specialization lifts productivity, which creates economic growth, which enhances the material standard of living, because the more stuff that an economy can produce, the more we all can consume. So therefore it could be argued that banks indirectly lift living standards, and going backwards along that logic chain, you could say, well, they encourage higher living standards because they encourage greater consumption, because the economy produces more, because the economy is based on specialization, because this cash overcomes a double coincidence of wants problem, and to function we need banks. So cash in the banking system overcomes the double coincidence of wants problem that's associated with running a barter economy. This is important, as I say, because specialization boosts productivity, and productivity growth rather is the engine of long-run economic growth. Almost a digression here, but governments benefit enormously when societies move away from barter towards a cash economy. The reason for this is that it's far easier to collect taxation in a cash economy. That should be obvious to you, but if you've got a barter economy, you know, you'd have a chicken farmer who wanted to eat bread, swapping a chicken with a loaf of bread. So how does the government tax economic activity when people are swapping goods and services? You know, would you, as a chicken farmer, would you receive your tax bill in the form of we need 3 chickens from you, Mr. Watson? Unlikely. So basically the government benefits enormously from establishing a cash economy because it helps them to collect tax. So therefore banks tend to be strong supporters of banks because banks enable the government to run a cash economy, and a cash economy enables the government to do what the government loves doing more than anything else, which is collecting tax. So let's think about how we might evaluate the issue of the importance of credit to a developing country. And we could do that by thinking about what it depends on. So we could think back to Harrod, those two guys, Mr. Harrod and Mr. Domar. It's really important that we have access to banks, because if we don't, there'll be a disconnect between savers and borrowers. There'll be a permanent credit crunch, a permanent shortage of commercial loanable funds. And if firms can't borrow, they won't be able to invest. So therefore, economic growth will be held back by this Harrod-Domar style savings gap. So I'm not sure if that's evaluation yet, but we can maybe pick up this on this in a minute. Yeah, so you could say, well, one thing is you might have banks, but are they trusted? If banks aren't trusted by households, ultimately, if you're a saver and you park your valuable savings with a bank, you'll only do so if you've got confidence in that bank that they won't steal or lose your savings. So in some developing countries, you might actually have banks, but those banks haven't got a great reputation. Maybe some of them have collapsed in the past, and bank runs are maybe quite common events. A bank run occurs when savers lose confidence in a bank, and because of that, they all turn up at the bank at the same time and ask to withdraw their cash. Of course, no bank can do that, because where is the savers' money? The savers' money has already been lent out into businesses. So what I'm getting at here is that it's really important that the general public have confidence in banks and that they're trusted, because if they're not trusted, households will choose to save at home, and then we'll have this lack of loanable funds again. In the UK, the government pledges that the first £85,000 of savings that you have in a bank are guaranteed. So even if the bank that you bank with goes bust, you won't lose anything unless you have more than £85,000 worth of cash savings with that particular bank. That's called a bank deposit guarantee. It's quite interesting, really, that is just a pledge. Really, the government doesn't have the funds to do that. If a big bank did go bust, in all probability, the Bank of England would be just asked to do some QE, and savers would be recompensed in that way. The clip on, well, the image on the screen there is from a fast show sketch. You can find it on YouTube if you actually put in inflation, the fast show. I found it very, very amusing. It's a comedy sketch about a fictitious Latin American developing country that's hopelessly corrupt, and surprise, surprise, the central bank goes in for reckless money printing. This was in the days, of course, when no one ever dreamt that the Bank of England might do anything like quantitative easing, which is the polite name for printing money. But anyway, you might have a banking system, but households might not be very keen to avail themselves of those banks if the currency that they're saving in is a lousy store of value due to high rates of inflation. In that situation, what tends to happen is capital flight. So people who have got cash savings won't want to save with domestic banks in domestic currency due to the horrendous negative real interest rates created by sky high rates of inflation. So what they'll do instead is save abroad, or maybe seek out other stores of value. It might be gold, or it might even be durable goods that they can barter with at some point in the future. So again, what financial markets, they need a stable store of value in order to work effectively. Okay, a short digression. possibly into your future. About 18 months ago, I read a really interesting book about how banks were absolutely desperate to abolish physical cash and use digital forms of money instead. So this movement towards a cashless society. From what I hear, Sweden is pretty much already there. If you want to buy anything in Sweden, you do so with your phone or with some sort of contactless card. Even in Britain, you're beginning to see it. I've encountered it on a couple of times where I've been unable to purchase what I wanted because I wasn't able to pay in cash, and because I'm uncompromising, I would rather not pay with my chip and pin. Anyway, look, what are the advantages of going cashless from a bank's point of view? Well, obviously it makes bank runs impossible. There's no requirement to pay savers any interest in a cashless society, because that your savers might turn up at your bank asking for their money back, but in a cashless society there's nothing to give them back. All they've got is a few binary digits on a computer screen. So banks, I really do suspect this is imminent, really, the abolition of physical cash. That would enable banks to charge negative nominal interest rates. So, for example, you might start off the year with £1,000 of your cash in the bank. At the end of that year, you might find that you've only got £990 worth of cash in the bank. The bank basically taking that £10 away as a negative interest rate. There'd be nothing really you could do to stop that in a cashless society, because you can't go to the bank and stuff it under the mattress, because there isn't anything physical, cash-wise, to put under the mattress in a society with only a digital form of money. The government would be, well, they already try to justify the movement towards a cashless society by saying that it would stop criminal behaviour, prostitutes and drug dealers. At the moment, they don't transact using credit cards or contactless debit cards, because the transaction is known to the authorities, and obviously they're engaged in illegal behaviour. So if you get rid of cash and have a cashless society, then it would be much harder for people operating in the unofficial black economy to operate. The mafia in Italy would be history in a cashless society. I wouldn't be surprised at some point in the future to hear or watch or listen on the news to some sort of story about how there's been a scientific discovery that the main transmission mechanism for COVID-19 was on physical cash. The virus can live on banknotes for 8 years or something ridiculous like that. So COVID-19 could be used as an opportunity to abolish physical cash. Again, we're beginning to hear these sorts of noises already about how we should, to reduce the R number, maybe we should use contactless. So who knows? I might be completely off base there, but who knows? Okay, so I think that's the end of this video about money and banking and access to credit, and how it can affect growth and development.